Josh Moorhouse. I'm the account executive here at Mutual of Omaha for Family First Life. And you reached out regarding some questions on IUL and being able to understand the product a little bit better. A lot of this is going to be geared more around the IULE, but I will kind of talk about differences a little bit with our fully underwritten product as well. And hopefully we can get into a couple of illustrations to show how some of these will work for them and be able to provide solutions for a lot of different people. So I'll share my screen here real quick. Oh, I don't think I have access to it. Am I able to share my screen?
Christina's going to mess with that. She should be able to get it done.
You should be all set now, Josh.
All right, thank you. All right, can everybody see it okay? Good.
Sure.
All right, so like I said, most of this is going to be around the Index Universal Life Express, but the actual way it performs and how the product runs is going to be the same for any of our IUL products. So for the IULE, and actually this has been just changed as of yesterday. We actually go up now from issue ages 18 to 70. Now we have 18 to 75 on this product. And so brand new change for the IULE TLE is our age change. And we will go up to age 75 now. It is still 65 for tobacco, so that did not change, but everything else is the same on here. For the face amounts, we're going to do 25,000 to 300,000 on ages 18 to 50, and then goes up to 250 from 51 to 60, and then 150,000 for 61 plus, so 61 to 75, maximum 150,000. So the risk classes on this is either standard tobacco or standard non-tobacco. And we have a few different index strategies here. I can go into that a little bit more when we go through an illustration to give an idea of what these different ones will do. So underwriting requirements on the IUL Express, we are going to be the same as the Term Life Express. We use the same application, as well as on this one, we do have a bill chart, an MIB, a farm check that we run, and then MVR is mandatory from 18 to 35. So either having a driver's license or a state issued ID, we can run the MVR for that as well. And then as needed for anything ages above that. Then a phone interview is needed as well. 51 to 60, going to be the same, except for obviously no mandatory MVR. It's just going to be still as needed. And then 61 to 75, there is one added step that we have. We do have a check on lab history. So if a client has completed lab work that we're able to access, then we will double check on that to make sure that it is within proper levels. But again, we will not require them to go get labs if there's nothing there. It will just be something that we will go and check our database if there's anything available. So in terms of how an IUL works, and this is going to be across the board for any of our IULs, we will have a portion of it of premiums paid that goes to the life insurance protection and policy charges. And then the other portion goes into the cash value build. And so that is really where the IULs set themselves apart, is being able to accumulate cash value and the fact that we can do flexible premiums on this product. And again, I'll go into that a little bit further because it's the easiest to do and show on an illustration. And we'll get to an illustration after and going over the product a little bit more. So part of it is so you can either go into a either fixed account with that, or you can go into an index. So index is going to be vast majority of what we see get a higher return on the cash value. So in terms of what IULE can offer, we do have what's just called a easy solve premium on an IULE. And that might be something that some of you guys are already familiar with, just because we do have a ton of IULE that is sold through Family First Life. So some of you might have some experience with that. And it is just the most simple way to do our IUL. It's going to basically at average return rates get out to age 120 for a client. So it's going to be a permanent solution as long as they keep on paying throughout the years and do not take out any withdrawals from their cash value. Then that will be an option for a whole life type policy for them. It also offers simplified underwriting, so no medical exams or any type of doctor's records being pulled. There's going to be a death benefit, but also that cash value build that it will be within the S&P 500. It also helps with keeping policies in place a little bit better in terms of as long as there's cash value on the policy, then the policy will remain in place and they can use cash value to cover those expenses for cost of insurance and policy charges that I discussed earlier. That also helps for the client's perspective and yourself in terms of being able to keep policies on the books. With this, there are also some a portfolio of no-cost riders that come with it. So a lot like our Term Life Express, where we're going to have a terminal, chronic, and critical illness riders that all come with the product. There's going to be a waiver of surrender charges for partial withdrawals if on certain circumstances, so they can have the access to their full money at earlier in the policy if certain life events happen. Then we have a guaranteed insurability rider and a lapse guard rider that would protect in retirement. So the terminal, chronic, and critical illness is going to be matching basically what we have on Term Life Express as well. We have a terminal that it will include anything for life expectancy of 12 months or less. They can have 80% of the original face amount available. Chronic illness is going to be the same thing, up to 80%, in which they have had 90 consecutive days of not being able to perform 2 of the 6 activities of daily living. Then there is a critical illness that will include different life events that happen, whether they are diagnosed with ALS, major organ failure, heart attack, kidney disease, life-threatening cancer, dementia, or an aortic aneurysm would all be included with critical illness and things that will be covered to help them out with those costs. A terminal illness rider, again, you're going to have an 80% that you're going to have available. So if it's a face amount of 800,000, you'll have 80,000, and there will be an adjustment for actuarial charges. That will basically be the interest that could be gained with premiums as well as the premiums themselves. And then a administrative fee of $100 to be able to access the money early. Give a death benefit in this scenario of $76,300 and still have that $20,000 for the remaining death benefit. Because they are going down to $20,000, we will reduce their premiums based on a $20,000 face amount instead of the $100,000 that they were paying before. The other option would be that critical, chronic, and terminal illness riders. Critical and chronic illness riders. And on this, there's going to be a variance of life expectancy depending on the seriousness of their condition. And we do vary our actuarial discount on that. So basically, it's an adjustment of premiums plus a 6% interest that we wouldn't be able to get on those premiums on that actuarial adjustment is kind of how it is calculated. These are just scenarios and examples. If anybody goes through a process and trying to in being able to do one of these riders for a client, they will have to go through our claims process and call up our claims department. We will get doctor's records from there and be able to help them out with what they would have access to. So here's some different examples. The further the life expectancy, it means the further that we wouldn't have premiums coming in, and so higher the actuarial adjustment and lower total death, lower of the actual benefit offered from a check standpoint, and then the remaining will still be that 20,000. They can do this more than once. So let's say they have a 8-year life expectancy. They can access this multiple times up to the 80%. So if they did like 20% over multiple years, then they can do it that way to up to that 80,000 or maximum 80% of the policy. We do also have a guaranteed insurability rider for those that can qualify. So if the specified amount increase is not exercised, they either marriage, adoption of a insured child, birth of insured child, or the third policy anniversary, and every 3 years after will be when they be able to access guaranteed insurability rider. And it's basically adding more coverage without any type of underwriting. So if they were to get a terminal illness or would or receive a illness where they would be otherwise uninsured, they can still get more coverage through a guaranteed insurability rider program. But they have to, if they don't access it in 7 consecutive years from the start of the policy, then it does no longer get offered after that. There is an ability to go up to 200% of the original death benefit or 250,000, whatever is less. So if they had a 300,000, maximum is they could add another 250. Then waiver of surrender charges. Again, this is going to be a way to access their full cash value earlier. In the first 15 years, we do have some type of surrender charges that does limit how much they can borrow in the first 15 years of the policy. After that, there is no surrender charges. But if they do have any of these where they're unemployed, hospitalized, disabled, diagnosed with terminal illness, faced with death of a spouse or minor dependent, or physical damage of 50,000 or more to their primary residence, or transplant surgery, we will waive any of those waive any of those surrender charges so that they would have full access to their cash value earlier than that 15-year mark. We also have a couple of for-cost riders. You have an accidental death benefit rider, a disability continuation of claim premium rider, disability waiver of policy charges, and dependent children rider. Go back here. I'll explain the other one. These real fast. So accidental death benefit rider is just going to be, you can add a addition in case they pass away due to an accident. The disability continuation of plan premium means that basically they can keep on having premiums added to their policy if they become disabled, even if they're not paying for it anymore. And then if they become disabled, we could also waive policy charges. So there's 2 different ways that they can handle that with disability. And then dependent children, it would be either 5 or 10,000 that they could insure their children. while they're still minors. This is something that's more of a term versus our children's whole life that does go throughout the children's whole life of the policy. This one does cut off basically when the client's children get to age 18. I know I went over a lot of information there for IULE and how the product works and what the product is. Do you guys have any questions at this point?
Yes, I do. Thank you. My name is Heather. Nice to meet you.
Nice to meet you too, Heather.
There are some, I sell IULEs a lot, but I had some questions recently from clients that I'm going to ask you that are not, according to this. If you were to want to start at, let's say, the 2550, we'll pick 25,000, and then increase the coverage within the year, are you allowed to do that with an IULE? Not 30 days, after the 30 days.
Okay. You cannot do any face amount, increases in the face amount in year one of the policy. So you have to get at least through year one before you look into a face amount increase. Now they could add a separate policy if they really wanted to. And we just have that maximum of 300, 250, or 150, depending on the client's age. So they can add a second IUL policy to be able to increase it. But yeah, you wouldn't be able to increase that same policy in the first year of the policy.
And then if they want to, I'm going to say your answer is probably no in the first year. So say after the first year, if they want to just put money into it to do the be your own bank thing, are they allowed to do that after the first year, before the first year, or never?
So they can put more money into it immediately, really, on that end, as long as they don't exceed the kind of MEC guidelines. They are able to go up to a TAMRA 7 pay amount, which I can show you on an illustration, but every illustration will have a TAMRA 7 pay amount. And so as long as they don't exceed that, they can pay into the policy without having to worry about it kind of going into that MEC guidelines as much as they want to up to that point.
And do they do that by calling, you, or how do they, like, if their payment is $50 a month and they want to put in 75, how do they adjust that once they've already received their policy and they've been paying on, let's say, a couple months or something?
It's just call in our customer service department at that point. They would most likely have them fill out a new bank service plan form that says that they are now going to take out, instead of $50, they're going to take out 75, for example. And they can just adjust it at any point in time for that.
And we're allowed to do that for them as long as we have them on the phone and get their approval and all
Yeah,
that?
as long as they're on the phone, correct.
I appreciate that. Also, I'm sorry, guys, one more question. The riders that you said, accidental, children's, and the other two disabilities that they pay extra for, is that in the IULE? Is that an option somewhere?
It is, but you'd have to run an actual Winflex illustration and do without EasySolve to do it.
Okay, got it.
Yeah, and so with EasySolve just includes those already included riders, and all the pricing is based on that.
Okay, perfect. Thank you so much. I appreciate it.
Of course, yeah.
I have a question. So I
Sure.
need to do an illustration through Winflex every time I do an IUL. So every time when I submit the application.
So on the IULE with EasySolve, you do not have to do a Winflex illustration. So that is built into the application. And so
Okay.
when you do the full application, it will also apply the signature to the illustration. But any other scenario outside of just the EasySolve, you would have to go into Winflex and build one.
Okay, thank you.
Yeah.
Josh, I'm sorry. Can you say that one more time, dear, what you just said about the illustration?
So the illustration for EasySolve is
Yeah.
now built into the application. And
Oh.
so when you apply signatures, it also applies signatures to the illustration itself. And so we still need an illustration, but
Oh,
the one attaches already. So you don't have to go to Winflex and attach it. And then so it's now built into the EAP software.
so
But
there's no
anything
more sending in an illustration, Josh?
just on Easy Solve. So
Only on
anything
Easy Solve.
anything that you do without Easy Solve, like her example of trying to add a accidental death rider or anything like
Mm.
that, where it's outside of those guidelines,
Mm.
then you would still have to build the illustration through Winflex and send it in that way.
Right. Okay,
So,
and then
Joshua,
one
Joshua,
last, I'm sorry. Go ahead.
can you explain me what is the difference IUL with Easy Solve and without Easy Solve?
So Easy Solve is just a set of options within the IULE. So it sets it so that the policy goes out to age 120 at average return rates of the S&P 500. It has that 100% participation account, and it does not include any of the paid for riders. So it's just a list of options that are automatically set on an Easy Solve versus without Easy Solve, you will have an opportunity to change any of those options. And it is also within the IULE. And even though if it starts at Easy Solve, you can still change that after the fact. But at least some of the options won't be available after year one, but you can change things like the premium even within year one, like we had the question a little bit earlier on.
Okay, so the best option for IUL with mutual is made to do IUL with Easy Solve.
If you're just looking to have it be like a in-place policy for a client all the way through their lifetime, and the premiums are the same all the way through, and they continue to pay that amount throughout their lifetime, yes, that would be the best option for kind of a whole life solution for a client. But not necessarily if somebody's trying to do it to gain more cash value and take out money a little bit later on, which I can show an illustration on how to do that.
Thank you.
Okay, I have one last question. Josh, way back when these first came out, Brent Bench, I had a training and he had sent out the training to me. So for people that couldn't have it, is that something you can do? Do you have anything like that? Or if Marissa has this recorded, can she send the illustrations with it? Will it have
She can absolutely she's having it recorded, so she can have anybody access it that would like access to the recording. And so that's open. And
okay, great. If you could send it to me then for people that didn't get on. Okay.
Absolutely, yeah. It will be posted and we'll also, blast it out to the team as well.
sure,
Thanks, honey.
Thanks.
Thanks, Josh.
absolutely.
Josh, real quick, I just wanted to go over with the crew, when the difference of when I write an IULE versus another IUL, if that makes sense and if that's okay.
Yeah.
So an IULE is very simple to do. It's anybody who's, I know technically it's now 70, but anybody who's healthy and under the age of 60, it's going to be less expensive for them for $25,000 than any other carrier that we have. So how I do it, this is just how I do it, is if they, if I get a hold of them and they're like, oh yeah, I want a death benefit, blah, blah, blah. The 25,000, if that fits within their budget, then I would automatically do an IULE because it has so many more benefits than a final expense to someone who's 35, even 50, 55, 60, I've found is kind of equal, if that makes sense to everybody. And like he said, with the cash value, when you're up in your 60s, you don't have much time for that cash to grow. But it's still a better option for us to give our clients than a final expense. Does that make sense?
Yeah.
Um,
So
But it's
up
not
to
for everybody, right?
yeah,
Like if they've
yeah.
got sort of like health issue,
Mhm.
they're gonna get declined and you might want a different option for them. So that's kind of what I kind of want to throw out to everybody. The finance part of it is way better for them to say, yeah, I get 25,000 for today. A guy who was a truck driver, he was like, oh, I can't do an IUL right now. And I'm like, why? And it was because he couldn't afford it. He thought he couldn't. But I ran the IUL, and for $17 a month, he was like, oh, I can do that. Now, the cash value part of it, I explained to him, it's not going to accumulate a lot of cash right away, but as soon as you get more money, that's why I had asked you that question, is when can he add more money to it, to allow for what he really wanted. But at least he's getting his foot in the door. He's healthy right now. He's, has no medical issues. He's got that ability now, where in next year, we don't know what's going to happen tomorrow. And that's kind of how I propose it to my clients. I just kind of wanted to let everybody know.
Thanks, Heather. Appreciate you.
Yeah. And it definitely is a much better cost for the insurance on that side of things versus any of our kind of whole life options or the living promise option that we have. Definitely get more coverage for the same amount on the IULE, but there is a stricter underwriting process. Yeah, we are going up to age 75, so definitely an option for anybody looking for final expense. And kind of 25,000 for IULE is going to be right around 15 or so for living promise. And so you will get a lot more coverage for the same cost, along with all of our riders that go with that, that we don't offer on the final expense side.
If you don't mind, I have one more question, Josh. I'm
Yeah,
sorry.
sure.
I do this all the time. So
You're great.
one of the clients today had asked me, he had heard something about a return multiplier. I told him, honestly, I didn't know what that meant. He explained to me. Is in any of your products?
It is not. So we don't use multipliers on our IULs.
Okay, thank you.
But yes, that is a something that some other companies do have on their IULs, and we do not use multipliers though. Our whole process is we try to keep it as simple as possible for IULs, and so that's why we only use the S&P 500 that we will follow on it, and only a few different crediting versus other companies. You might have 30 different crediting options, and then have multipliers that go along with it, and can be pretty complex. But we try to keep ours as simple as possible and easy for people to understand. And so we just have the one index we follow, and a couple of different strategies, which I can touch on in just a second when we do an illustration here.
And then is there any time that you're going to go under 18 or that you've heard of?
Our fully underwritten does. So we do allow for income advantage and life protection to be 2 weeks old on up. But
Oh, okay.
we do not have it for IULE right now, and not sure exactly when we it is something that we have looked into about going lower than 18, but the problem is that a lot of those kind of requirements that we can easily do are going to be hard to get with juveniles. So that is something that we are looking into though for IULE, and it is available right now with fully underwritten. Okay. All right, so we going on, we do have some training available. I know that Teresa asked about some training, so we have some things already in place. So we do have a training website of mutualofomaha.com/simple that will include all the IULE products as well as all of our simplified issue products. And so it has a lot of different materials and some videos on, especially if you haven't written one yet, there is an e-app video that does a great job of going step by step through that. Then there's discoveriul.com that is more focused on the fully underwritten products and does a breakdown of how to use those. And again, materials, there's going to be a sales support line that you can order any of our materials with paper copies. And then we also have forms and materials available through SPA to get any of those. So that's what I had, at least on a slides perspective. Now, I'm going to bring up our screens for Winflex, and I'll go over a couple of our different illustrations that we have available. So I also brought up just our discoveriul.com. So here is the website for Discover IUL, and it does include some of the fully underwritten products. So it says, how does IUL work? So it kind of gives a indication on just how the cash value accumulates. Then it has the income advantage product that's going to be more based on cash value. So if you have a client that's really trying to get as much cash value as possible, then going through the income advantage route is the best way to go. Then you also have the life protection advantage IUL. So that's going to be fully underwritten and will focus more on the life benefit and being able to secure that for a client. So that is kind of how it breaks down on fully underwritten side. It also goes out to age 80 for fully underwritten. So there is going to be an opportunity to be able to insure clients at an older age, but it does start at 100,000 for coverage. So keep that in mind whenever we go fully underwritten versus any of our simplified issue products, is that the limits are a little bit higher starting out, and there's a possibility that you can get a cheaper cost of insurance that way for very healthy clients, because we do have more qualifications in place. And then it is, though, going through fully underwritten, so possibly needing a paramed exam, doctor's records being pulled. So definitely a longer process on fully underwritten than express, but can also help the client a lot by going that route. Then for Winflex, so this is going to be our quoting software for the IULs that we have. So everybody will be able to create a login for free, but you will have to create one to start it out. But it's winflexweb.com is the website. And we would go to illustrations. So what I'm going to do is I'm going to run two different scenarios of one kind of doing a cash accumulation, and then one being able to stop payments a little bit early. And then I could do a quick one for easy solve as well, just to show kind of the most basic option for IULE too.
And I actually have a guide for you if you want.
Awesome. Okay. So you got the IULE training for
Yeah,
just easy solve one? Great.
I've done that for a long time.
Great.
But this is more of the, the fully underwritten, this guide.
Sure. Oh, awesome. So for the, and I mean, for anybody we can run this scenario with, we just have to change up the amounts and but all the options to run it are going to be the same. And so I'm going to start with someone just trying to
He's 44.
44.
guy.
Let's
Yep.
do it. 44. And then what state would it be in?
He's in Washington,
Okay. Washington.
and he has a goal with, minimum death benefit, maximum cash value. So this is the right way to run for him.
Yeah. So, yep, to maximize cash value, what we normally do is do a face off in this instance. And again, it's going to go to this minimum face, maximum funded premium. And then you would put in the amount that he's looking to pay.
He's looking for about 300 a month.
Okay, so let's do 300. Again, minimum face, maximum funded. You're going to put in your premium amount here of 300. Then I will go into index strategy here to show kind of our different ones real quick. So we do have most of them, 95% of them are going to come in probably at this 100% participation account. For one, it's the easiest to explain, as well as it does, on average, perform the best over time. So it is a strategy that will follow the S&P 500 from 0 and 9.25%. So it has a cap of 9.25 and then it bottoms out at 0. So if it has a negative 30 return, you're still at 0. If it has a 30% return, you're capped at 9.25. So it
Is
just
the
follows.
IULE 15%?
This is the IULE. So IULE maxes out at 9.25.
Oh, I thought it was 15.
The income advantage will go up to 10. So that's going to be our highest return possible for a product, but 9.25% is our IULE. And then we have a 1-year high participation account. What that would mean is, let's say it operates at 3%. We're going to multiply that by this participation rate, which is 1.4. And it comes out to be about 4.3% return. So it works well if it's a lower return because it does cap at 6.5. So it can't go any higher than 6.5, but if it is a lower year of like 3, 4, 5%, then it will be a higher return for that year than our 100% participation account. But again, it averages about 4.5 over the 65-year average we take versus 5.9 for 100%. Then for the uncapped, there is no cap on it, but we do multiply it by, again, a participation rate. This one is 45%. So let's say it's a 10% return. We're going to multiply it by 0.45, and we're going to have a 4.5% return instead of 10. But like let's say 2019, it went up 30%. You would have about 13.5% return because there is no cap. Again, it doesn't quite perform as well as the 100% participation over time, but there will be years that it might perform better. You can change this from year to year. All of these are calculated on a yearly basis, but let's say somebody expects it to have a really good year in the S&P 500, you can switch it over to uncapped and have it based on that percentage and then switch it back to 100% the next year. So what you set it at to begin does not set it for the entirety of the policy.
One quick question that I just remembered they had for me was, is this a daily, when their percentage goes up, is it a daily check? Is it monthly? Is it yearly? How does the money grow?
It is yearly, so it's a 1-year check-in. So let's say you start it, put the policy in force, and it's at $100 a share. 1 year from now, it's 110 a share. It went up 10%. Then it'll whatever it does during the year does not really have an impact. It's just what it starts and ends at.
Okay.
And then so that is for any of those indexes on there, is that it's all 1 year. So that's what we mean when it comes to that 1 year, is that's when it's calculated.
Okay, thank you.
Yep. So the next thing that we'll do a little bit different on the trying to gain cash value as much as possible is we will change the death benefit to an increasing death benefit. What this does is allow it to drop the death benefit as much as we can, and without it becoming a mech. So it will lower that down, and it just has to stay within a certain percentage of the death benefit. And it will increase the death benefit every year based on how the cash value grows. So as the cash value grows, the death benefit will go up. I'll show you that on the illustration as well. So that's kind of the main things that we would want to do when trying to increase cash value as much as possible. Is what you're doing is you're doing solve for, you're doing a minimum face maximum funded premium, putting in your premium, and then you're doing an increasing death benefit. And then you can then calculate from there. Go through, it'll tell you your initial death benefit of that 63,141. Your illustration's going to come here. Be able to click on that. And then get a summary page here. One nice thing that we include if people ask about what our returns look like or what they've looked at recently, what it does is it shows you how we come up with that 5.9% average. It is based on a 65-year look back. We use 25-year periods within that, and we will do the worst 25-year was 3.76. The best was 7.3. So most likely the client's going to fall within that period. Then we also do a 20 years of returns to give an idea of what our returns are year to year. And this is going to be somewhere around page 9, page 10, page 8 of the illustration. It depends a little bit on the state, but it should be right around there. Then it goes over a lot of the different benefits, no cost writers, numeric signature page. This is where they'll have to get a signature on anything that's not easy solve. So page 23 on this illustration. And then this is what I mostly use when I'm talking about cash value accumulation. It's going to start it with the policy ledgers. So it gives a year-by-year breakdown of the premiums paid. And then it does have 3 different columns. It has guarantee, which is going to be flat 0 return, a alternate scale, which is basically taking it at half of what the average return rates are. It's a little bit higher than that. Then there is a non-guaranteed, which is that 65-year average. So we would expect it to be closest to around here. It might be a little bit higher, it may be a little bit lower, but should follow it pretty close through the years.
So may I ask you a question for this guy? Let's just say, and if he start borrowing money from it, if we're to show him this, am I right to think that in that first year there's $2,700? Likely you shouldn't borrow money from that, but if you had to, you could. But by year 5, he's going to have 13,000 approximately. Am I right to think that way?
Yeah, so the surrender value is going to be actually a value you can borrow against unless it's one of those circumstances where we'll waive surrender charges on that rider that's included with it. So other than that, though, they can only access the surrender value on the policy.
Okay,
And this is after year one, so end of each policy year. So end of
Right.
year one, you're looking at 1,190. Unless they have one of those events happen, that we would waive surrender charges. But it does decrease in terms of the surrender charge each year as the policy goes to age 15. But by the 15th year, there is no surrender charge, so it's going to be the same. So, but by 14, as you can see, it's very minimal at that point. It's just about $110 or so difference on after policy year 14. So it does go down as you go along, but the surrender value is what you want to say they can borrow against.
okay.
Then as you can see here, it's going to total all the premiums. So by that point, you're at 20 years, you're at 72,000 premium. You have about 114,000 in cash value, and the death benefit is raising each year by the same amount that this is going up. So you're going to take that 63,141 plus 114,868. That's how you have the 178,009. So that's how it will show as increasing each year as you go along. And you keep on going down. I mean, obviously, the further you go down, the more it'll show for return. So by, say, age 74, they're at 108,000. They're at 241,000 for cash value accumulation. So it will continuously compound on the money that is already there. So that is going to be kind of just setting up for somebody that is not so worried about the death benefit and you're just trying to maximize cash value. And those same options can be chosen on a fully underwritten product. So I know you talked about the fully underwritten. If they want to go income advantage, you can choose all of those same options. And that would be how you would maximize on the income advantage as well. So another thing that I wanted to give a quick example on is one of the nice features is that if you have somebody that is a little bit younger, let's say, again, we can do a 44-year-old, say they are just looking more on the life insurance side, but they don't want to pay by the time they get to retirement. We can do some options to have them basically pay off the policy early. And be able to still have a policy coverage in place all the way through their lifetime. So example on that would be going a premium solve. Let's say somebody wants 200,000, I mean, let's say 150,000. And they want to solve it all the way out to age 120. So that's what's going to be that solve for CV. It'll go all the way out to maximum, which is 120 for the client. And then what you can do is a year/age to pay premium. You can change this, let's say, to age, and they will pay till through 64. So they stop paying at 65. And then under policy options, we'll go back to the level death benefit. And we can recalculate. All right, so on here, then we have the 150,000. If you go to our illustration, again, we'll go down to the policy ledgers. This example, they will pay for 20 years and then they're stopping at 65. And again, their non-guaranteed cash value is going to continue to run all the way out to age 120 to be able to keep this policy in place while just paying 20 years of premiums. Let's say, and usually it's not even that much more. So then let's say the Easy Solve, which does pay all the way through their lifetime, we'll give a quick example of what that difference is. So it's 156.06 to pay for 20 years. So if we switch this to just our Easy Solve and go to, again, that 150,000. All these other options are going to be the same for Easy Solve. Back in here, we have $120. So basically $36 more a month. They would be able to basically pay off the policy in 20 years. So just another way to be able to help clients out and have the flexibility that an IUL offers and being able to give some different options for them. Guys have any other questions right now?
So far, I think so good. We're rolling
Okay.
along. I appreciate your
All
time,
right.
Josh.
Absolutely. I mean, that was pretty much what I had for different scenarios that I wanted to give. I'm happy to help out with any additional questions, though. You can share any of my contact information. I believe you have my phone number and my email address. And so share it out with the team, and I'd be happy to help you guys out with any other questions and training that you have.
And Josh, one last thing I just want to ask before we kind of hopped off. And I've been working in the industry for about 7, 8 years now. And when I came in, it used to be like, you need to call the company to know, exactly what it is and what it does. So with that being said, this was extremely helpful. But Josh, if there's an agent out there that's thinking, I might have this case, I'm not really sure how to approach it. Would you say the best way to how would you say the best way for an agent to go about that would be to call Mutual directly?
Yeah, so we do have that sales support line that I had given a little bit earlier.
Yes.
And so that would be a starting point to reach out to. And a lot of times if there is additional questions on which route to go, or if it's a little bit more complex, they might then send it my way on any of those questions. But that would be a great starting point to reach out to.
Perfect. Just always like to have the carriers, reiterate that, agents do reach out to the sales team, and that's what it's there for.
Yep, that's what we're here for. We
Awesome.
are absolutely here to help out.
Awesome. Well, we appreciate you.
Yeah, absolutely. We want to make your jobs as easy as possible.